Welcome to The State of Us. Real people with honest opinions and the future of responsible media. Here's your host, Justin T. Weller.
Everybody wants to have the highest credit score possible, but most people have little idea about how to go about getting it. In fact, the opposite is often true. The things that many people believe will help or hurt their score don't actually help or hurt them at all. And that's what we're talking about today. 9 myths about credit scores. Now, we're not going to do all 9. We're going to do 6 of them. Lance and I tried to pick out the ones that we thought were the most important. Why do you care about this? $13.9 trillion in total U.S. household debt. That's quite a bit. 17% annual percentage rate for a credit card. Pretty high interest there, Lance. Mm-hmm. And $8,602 is the average household credit card balance. So per credit card.
Yeah, that's not
That's
debt.
the average balance.
That's the average balance for the credit card.
Right.
At 17% interest.
I told Lance when I heard that, it made me feel better about my card.
Yeah.
So we're going to walk through some of these myths. We're going to talk about a couple of things that you can actually do that help your credit score. And then in the last bit, we're going to talk about better ways maybe to go about this. But of course, we couldn't begin this critical conversation without a proper introduction for
your friendly redneck liberal, Lance Jackson.
Yeah, well, and if you wanted to see all 9 myths, then you can always look at the story, right? Because we
That's right.
put those up for folks.
And they can find it where?
At stateofus.org, right?
You got it.
All right.
Lance's brain is churning
It
today.
is. I told you it was good.
Making butter.
Yeah, so, we're going to cover 6, but the other 3 are there as well. And there are some charts that we're going to take a look at, but at the same time, we were not going to look at everything. So,
That's right.
If we're looking at a chart and you want to see it,
Now you can.
If you're a visual learner like me, you can follow along. So,
didn't you say you were talking to somebody, one of our listeners the other day who has started using this feature some?
Mm-hmm. Yeah, they enjoy it.
Okay.
Yeah, because it's so much easier to follow along and they can kind of read along with us, and it makes the show even more enjoyable. They enjoyed it anyway, but it makes it even more enjoyable.
So, myth number 1, checking my credit score hurts my credit score. So this is a common one. I think this may be perhaps the most prevalent one. We're going to talk about 2 or 3 that I know come to mind.
Well, this one I told you is the one that I see on what little bit I get on social media. Mm-hmm. This is the one where I think they've been trying to dispel this myth.
Yes.
But it's still,
Working on it.
But obviously if it's out there in social media, it must be a pretty widespread myth, which is why I chose it as one of the 6 that I thought we should talk about.
Right. So the important thing to understand here that the article outlines is the difference between a hard inquiry and a soft inquiry. So generally speaking, a soft inquiry does not affect your score. And even some hard inquiries don't, but the easy rule of thumb to keep in mind is soft inquiries do not. Checking your own credit score, okay, is a soft inquiry because you're not extending credit to yourself. So it doesn't do anything to negatively impact your credit score. Now, on the other hand, a hard inquiry would be when you actually go through the application process. And I'm stressing that one, Lance, because I don't know if you've ever seen the advertisements for check your rate today. It won't hurt your credit score. And a lot of people kind of are hesitant. I was one when I first saw one of those where I'm like, well, wait, how can I find out what my rate might be and it not hurt my credit score? And the reason for that is because it's a soft inquiry, because you're not actually asking for credit. You're saying, hypothetically, if I applied for credit based on my current credit, what might that look like? So it's not the actual process, which is why when you do that, if you read the disclaimer, it tells you, this is not a loan offer. A loan offer would be disclosed through the application process, and a hard inquiry would be drawn on your report. So it does actually spell that out, but you have to be looking for it. So
that's why if you're just using some site to check your own, it really doesn't hurt you at all.
Do you do that, Lance? You ever check your own?
Nope. The only time I ever
have get in the mail?
Nope. I don't ever know. The only time I know is when I apply for a loan and at my local bank that I've used for the last.
They say you got a good credit score?
And they always go, oh my gosh. And I'm like, what? And they go, how much money do you want? I'm like, oh, okay. Is it that good? Well, yeah, we don't see anybody like that. I mean, to the point now I just call them up, and like this last loan that I took out, they were just like, yeah, how much do you want? I'm like, oh, okay. Well, gee whiz. I don't know. I hadn't thought about it that much. I guess I only want this much. They said, oh, okay. We can give you more. I'm like, no, that'll be enough. So I guess it's pretty
For
good.
now.
No, I mean, yeah. So I guess it's pretty good.
Right.
But I don't pay any attention to it. Never have.
Something else. And
Like I told you,
I
don't use credit. Other than my home and my cars, if I can't afford to pay cash for it, I don't buy it.
I know.
That's been my life. So I just naturally, I guess my credit score then is, as I read this, is pretty good. But I know that's not necessarily the way other people live.
So one of the things that's not listed here that I did want to mention is, and I hope this goes without saying, but I know that for a lot of people it doesn't. You do not have to pay to find out your credit score.
Right.
Okay. If you want to know what your credit score is, you can find out from FICO or the Vantage Score. You can find out from those companies without paying. Now, they will try very slickly with their website to get you to pay something to see your credit score. Now, the differentiation there, Lance, is right. You can find out what your score is, but you may not get all the data about what's impacting your score per se.
Well, there was an interesting point here in the article too. It said that, and this is about student loans, okay, which I did have those way back when. But over 400,000 student loan borrowers were sent a quarterly email reminding them of their availability of FICO scores. The scores increased by about 8 points over those, for those borrowers than those people who weren't getting alerts. So this group went out and said, hey, we're going to just test this, do some research. And they sent the score to 400,000 people. And those people actually improved their scores by 8 points over 8% over the people who didn't get. So
it makes a difference.
So what you're saying is if you will go on and find yours, don't be obsessive about it. But
yeah,
if you'll go and look at yours at least once every 3 months, the study seems to show that will help your credit score go up because you're cognizant of the things that you need to do to improve your credit.
Myth number 2, and this one's kind of interesting. This is not one of those things that I don't think I ever had this in my head. If I pay my bills on time, that's all I need to worry about. For many consumers, the assumption is that on-time bill payment is all that matters when it comes to good credit scores. But the assumption forgets about the importance of credit utilization, which is the percentage of debt you owe compared with the total available credit that's been granted to you. Utilization is one of the most important components of your score. If your credit cards are maxed out, your score won't look good. So,
well, yeah, the point is, if you owe $3,000 or $4,000 and you make the minimum monthly payment every month, that's not enough.
Yeah.
And that's what they're saying. Cause I had to think about that for a minute. Well, yeah, paying your bills on time is good. But if you owe a large amount of money and just because you pay off the minimum on time every month, that's not the only factor.
It's better than paying late.
Exactly.
But it's not going to make your score. For example, if you owe a really high portion and you just make on-time payments, it's not going to help your score. It may avoid it getting hurt, but it's not going to do anything to boost your score back up. Number 3 is carrying a balance helps boost my credit score. Now, this one I've heard quite a lot.
Really?
Yes.
Because this doesn't seem to make any logical sense.
Shouldn't make logical sense. But one persistent misconception is that to build a strong credit score, people should demonstrate activity by keeping a charge on their credit cards at all times. That is, they should carry debt over month to month.
No, why would you ever think that? What Kool-Aid were you drinking?
In fact,
for people to think that
22% of consumers who said they had carried a balance did so mistakenly believing that it would help their credit score, according to a 2018 survey. But they're wrong. Keeping a balance on your cards doesn't help and actually could set back your financial goals, which are better served by consistently paying off credit card debt in full.
Well, yeah, and you're getting charged interest.
Yes.
It's costing you money. So why would you think that would be a positive?
Well, that's probably that's probably why it was disseminated, right?
I'm making fun of 22% of the people that I guess, but I really feel sorry for you because I can't believe you would think that. The concept is that yes, you put something on a credit card and then you pay it off at the end of the month, then that makes your credit score go up, but not carrying a balance.
Right. Well, I think the logic goes that when you listen to people like, and you don't like Dave Ramsey, but when you listen to people like him who are really anti-debt,
right?
They talk about it's the I love debt score, and they don't necessarily say that carrying a balance helps, but what they do, like he specifically refers to it as the I love debt score because it rewards people for having more access, which is true, but there's a difference there. So people make the leap that, well, if I carry a lot of debt, that is a good thing, where it's where he's not always as specific as he should be about.
That's the thought process that they're using to come to that conclusion, but it's wrong.
Right. Having lots of available credit does help your score.
Exactly.
Using all of your available credit does not.
Right. That's like when I call my bank and ask for money, they're willing to give it to me.
Right.
Because my credit score is high because
you don't ask for money very much.
Right.
So they're more likely to give it to you when you do ask, yada, yada.
And I get a better interest rate.
Yes. And you get a better interest rate, demonstrated history of paying things back, paying things on time, all of that type of stuff. And taking out things like a mortgage and reliably paying it down, which is something that makes a difference. So we've got more to look at here. More myths, 3 more myths to go through. And we're also going to give you a couple things that you can do that make a substantial difference. So we've got plenty more to come. Keep it right here on The State of Us.
We are The State of Us. Here's your host, Justin T. Weller.
Everybody wants to have the highest credit score possible, but most people have little idea how to go about getting it. That's the opening of the article we're referencing from the Wall Street Journal today. We're talking about the I Love Debt score, also known as a credit score, and we're walking through some of the common myths associated with it, which is kind of actually debunking the I Love Debt portion because it's more about I love access to debt more than I love debt itself.
Exactly.
So we've walked through a few things so far, and we've got 3 more to walk through, and then we're going to go into a couple of things that you can do that will help boost your score. So myth number 4, Lance, closing an old credit card with a high interest rate will help my score. This one is kind of interesting.
Yeah, it's you gotta.
This is where following, right.
This is where following along in the article might help because this one's it makes sense, but I had to read it twice to make sure I understood it.
Yeah, you got to process. So sometimes the first credit cards we get when our credit profiles aren't well established have higher interest rates than the more competitive cards we can qualify for as our credit usage matures. And people, especially those with low scores, often assume that shedding some credit cards will help boost a credit score. So they close the cards with the high interest rate and keep the ones with the lower rates. But the truth is that closing an older credit card, that's the key here, older credit card, won't help your score. And it might actually hurt your score. Now, why is this? Well, that's because in both the Vantage Score 3.0 and the FICO score, the length of time that you have had access to a particular line of credit, which is what a credit card is, affects your score. I.e., if the average age of accounts is
in a positive
higher,
manner,
that's a good thing. Right.
So if I've had it since I was in college, but because I was in college, it gave me a higher interest rate.
Right.
People want to get rid of it. But in actuality, if you've had it for 20 years, keeping it's a good thing, especially if there's not an annual fee attached to it.
Yeah, it doesn't cost you anything to keep it.
Then you're rewarded for the fact that somebody has been willing to extend you credit for so many years.
Yes. And that you've not done anything to lose it, all of that type of stuff. For example, I think the very first credit card I ever got, Lance, was a store credit card for American Eagle. Now, yes, people can judge hard, but this was, it was like when I turned 18 and I wasn't even thinking about it, but it was one of those deals where you could get like 40% off that day if you got the card. And you didn't even have to, and here was the real kicker, you didn't have to get approved in order to get the 40% off, you just had to apply. And I'd never applied for anything before.
Sure.
So I thought, I even told the person when I applied, I said, well, I'm going to get turned down, but you're saying that doesn't matter, right? I still get the
40%
right.
off.
So it's like, let's do it.
Yeah.
I get the 40% off. I mean, absolutely. And then they're like, oh, well, you've been approved. And I'm like, oh, okay. Well, it's not really what I wanted, but so I've had this card a long time.
Right.
And there's no balance. I don't think on the, or there's like $4 or something once in a while, cause I forget what it's connected to. But there's basically no balance on it.
Mm-hmm.
But I've kept it for that very reason, because it's the longest card that I've had.
Longest running card in your pocket, huh?
Right. Well, I mean, it doesn't do me any good to get rid of it. It's not going to change anything.
Here's one for you. What was the original Diners Club card made out of?
Ooh, I don't know. Not plastic, apparently.
It was not.
Metal.
No.
Paper.
Close. Cardboard.
Really?
Yeah.
Interesting.
So, I don't know.
Cardboard.
Yeah.
I don't feel like that would hold up very well.
That was the original Diners Club card. Was issued in.
Okay.
I don't have one, but
fun fact.
Yeah.
From our senior historian. This is the useful knowledge that we
this
store.
sits in my brain for no reason and comes out in times like this.
Well, fun fact. Okay. So myth number 5, opening a new retail credit card is good for your score.
See, and you just use that as an example.
I know that was so retailers.
So it's okay if you've had it for a long time.
Yes.
But don't go up and open a bunch of new
thinking
ones.
it will help.
Yeah.
The big thing here, retailers constantly tempt us, Lance, to open up a new store card, right, by offering purchase discounts, which is what got me, or a promotional 0% interest period, which gets a lot of people. And some consumers believe that doing so can help their credit if they pay off the balance within the promotional period. But every time we open a new card or take out a loan or qualify for a mortgage, for that matter, the overall average age of our credit takes a hit. So this is tied into the last one. Mm-hmm. Opening the new one, yes, increases the amount of access you have credit to, but so it does two things. It helps, but it also hurts because it increases total access to credit and it decreases the average age of accounts. So this is one of those that I think is tough because essentially at best, it's probably a wash.
Right.
And at worst, it hurts your score.
Right.
Hence the myth.
Well, and go back to the days of easy credit, show my age. Every time you walked into a sporting event, somebody was there having you sign up for a credit card. And just by signing up, you got some kind of gift.
Right.
I don't know if you remember those days or not. So I have a stack of credit cards at home that I never activated. But I remember when I went to try to get my first home equity loan, my banker said, well, your credit score is not very good. And it's like I had applied for all these credit cards. So I had to go in and, call the number and cancel all of them. And so, I still have them as, like souvenirs.
Yes.
And a lot of towels and, drinking cups and, newspaper subscriptions I got for free.
Yeah.
Right. Got all my freebies. But that's where I knew that one was also one you don't want to do. I learned the hard way.
Credit reports are accurate. Number 6. Credit reports are accurate.
You can trust the government, right? You can trust technology. I mean, it's all good. Nobody would lie to you.
So,
right? You can trust technology. You're the technology whiz. We can trust technology. Computers are never wrong.
The Federal Trade Commission tells us, Lance, that 21% of consumers studied in 2012 found errors that resulted in modifications by the credit reporting firms. In 5% of the total number of consumers studied, the error was so serious as to affect the terms of any credit that they might be granted. Errors come from many sources. Sometimes it's a mixed file in which activity from someone with your same name has been conflated with your own. Your spouse's debts could still be showing up in your file. It could be a clerical error because your handwriting was misread. Sometimes a creditor mistakenly reports a late payment. In some serious cases, it's identity theft or fraud, which might show up on your report as a credit card or other account you never applied for. This is super important. The law tells you that you have the right to get those things corrected and that they're not allowed to affect your score. But of course, the problem with errors is people don't know their errors until somebody informs them. So the agencies have to correct them if you can demonstrate to them that these are erroneous. They're not allowed to stay on your file, and you're not allowed to be liable for those errors, because in most cases, obviously the errors aren't the fault of the consumer. There's some, generally speaking, clerical error.
So basically what you're saying is, if you think you've done all the right things and your score's lower than you thought it should be, this is one area where you could go and check and see if there were any errors that you weren't aware of. There are ways that you can go find out and get a report and check to see, oh, well, that's not true. Well, that's not true. And then you could go through the process of getting them taken off your report.
Right.
So this isn't something you would know in general, but
you might not ever be aware of it if you didn't look at your report.
Right. But if your score's okay for what you want, then you don't need to check it. But if it's lower than you think it is, this is one thing you could do, right? To check on it, to maybe help it go up a little bit.
Yeah. If anything about your score stands out to you, it's good to look into your credit file, which again, you have access to. It's not always, speaking from experience, sometimes these online managers, Lance, from the agencies themselves, don't always make it easy to see your credit file report. In other words, it will show you hard and soft inquiries into your credit from where, and things that have been reported. Now it doesn't give you like here's how many points you got for this thing. It doesn't tell you that. But what it does do, because they don't want people to game the system, so they, try to not tell people, what contributes to their score. Interesting conversation in and of itself, which we'll have here in a minute. So that's the important thing to note there, is you have to look into not just what your score is, but you have to go in and look at the things that have been listed on your file. And as Lance mentioned, there's really no need to do this more than quarterly unless you're really trying to make improvements to your score, or you're somebody who regularly exercises their credit frequently. Then you might want to look at it more. But beyond that, looking at it, I look maybe once a year, if I'm being honest. And that may not be the right thing to do, but I don't need to know really probably even that often. But checking at least once a year ensures that there's not some crazy, something going on here.
Well,
that I don't
so you don't
know
get
about.
blindsided if you're going to make a bigger purchase and you think everything's okay.
And then
then they come back to you and say, sorry, we can't give you a loan for this car. Or we can't, whatever. So.
Yeah. So it's good to know, but you don't have to obsessively check it like week by week. So good stuff to keep in mind. Those are some of the myths. We've got a couple things you can do that are proven to increase your score, and we'll talk about those in just a moment, along with some of our ideas about what could make this whole process better just generally than the way that it's done right now. But before we get to that, Lance, it's important that we remind people what we're trying to do here.
Here at TrueChat, our mission is to educate people by providing honest, open, and respectful conversations. And today we're doing that about credit scores.
And TrueChat is the company that produces The State of Us, right?
Yes, it is.
Okay, producing entity.
You're using big words. Erroneous, entity.
Okay.
You're big in the E words, but
yes.
Yeah, you're using them big.
Okay. So we've got more to come. We're going to talk about some solutions and some better alternatives and ways to boost your score. Keep it right here on The State of Us.
We are The State of Us. Here's your host, Justin T. Weller.
$13.9 trillion is the total aggregate U.S. household debt. So credit scores are probably something that impacts most of our lives at some point. And that's why we've been talking about it today. Some of the myths associated with credit scores. And per our policy here on The State of Us, we wouldn't be doing our job if we didn't provide some answers. Right, Lance? So we've talked about a lot of things that aren't true, but let's talk about some of the truths. So this one is from Ted Roseman, who's an industry analyst at creditcards.com. And he says, asking for a credit limit increase is one of the fastest, easiest, no-cost ways that anyone can help their score. Mm-hmm. Now think about why this is. In fact, and he doesn't mention this, but you probably don't know that most of the time when you ask for an increase, if you've had the account for a while, they will not even pull your credit. They will just grant you typically in the neighborhood of a $2,000 to $4,000 increase.
Right.
With nothing other than just asking.
Mm-hmm.
And the big thing here, part of why this is so valuable, if you think about it, right? It increases your total available credit.
Right.
It doesn't change the age of your accounts.
Right.
And frequently it comes with no hard inquiry.
Yes.
So it is the cat's meow.
Right.
I mean,
it doesn't hurt you in 2 or 3 ways, and it benefits you in one way.
Right. And the worst thing they can say is no.
And all you're doing is asking. Right. And if they say no, you say, okay, thank you very much. Have a good day.
Right.
Because you still have what you have. They're not going to take away
Right.
what you already have. So you have no
not
risk of
lose
losing anything.
The
Right.
only thing that may happen is they may do a hard inquiry on your account. Again, typically they won't do that unless you're asking frequently for those or unless you're asking for something that's beyond. And of course they don't tell you, but there's usually a threshold. And if you, and that's why you don't want to ask for like a $10,000 increase. If you ask for like $1,000 or something, usually that's
unless
approved.
you can show that
Right.
your income has gone up dramatically.
Yeah. I mean, if you have a $50,000 credit limit on a couple cards, then asking for an increase like that may not be a big deal. If you don't have those types of credit limits, if your credit limits are less than $10,000, you probably don't want to ask for an increase equal to the size of the credit limit you have because they'll say no, almost certainly.
They're not going to double it.
Right. They're probably not going to do that. So, another thing. So there's a couple new programs coming out, Lance. Experian Boost is a free program that launched, actually in 2018. By the credit reporting company Experian, and it factors household payments for services like telephone, cable, and utilities into a person's FICO score. So you link your bank account and it auto detects all these utility payments and it will take those into account. In other words, if you make those payments on time and you always pay what's due, then this will boost your credit score. You're shaking your head.
Only because you use the word link to your bank account.
I knew you wouldn't like that one. Well, but I mean,
I understand it, but I'm thinking of, young people that I know and that's the way they do everything. So, I mean, it makes sense. It's just, to me, scary, the information that we make available.
And those are a couple things though that you and I have talked about in the past is the type of thing that we want included.
Right.
Because those are payments that you
if you're
make
going
all
to
the
make
time.
them anyway,
Right.
If you're making them anyway and you're using, credit or however, then it should be because that's part of your monthly bills and it shows that you are a good credit risk because you're making those monthly payments every month on time.
Yes.
So it is obvious. It's just, I didn't like the word link.
Well, and a lot of people don't think of it this way, but your utility bill is a form of debt. We don't generally regard it that way, but keep in mind
we don't pay
as you
ahead
use it.
for it. We pay for it after we've used it.
Exactly. So, you spend a month using somebody else's service and not paying them.
Right.
And that is the very definition of credit.
Whereas your cable bill, they send that to you and you're paying it ahead of time.
Yes.
Sorry for those of us that still use that device of cable television, right?
So
not streaming or Roku or Hulu, or is that considered cable too? You have to help me on that one.
Streaming. Those are streaming services.
Okay. So they're not cable.
No, I don't think they qualify.
Gotcha.
So they come through a cable.
Yeah.
But they're not in and of themselves a cable.
Haven't made that jump yet.
No.
I'm still testing out streaming through my cable.
I know.
But
you do use streaming. The friendly redneck liberal uses streaming.
I do. Yes.
I think it's important to let people know.
I'm not in favor of it so far, but I'm trying it.
So the next thing, speaking of bank accounts.
Yes.
In a program
I don't want people to know mine.
In a program that's expected to launch in 2020, FICO will begin taking into account consumers' banking habits. Under the free program, which is called Ultra FICO, consumers sign up to allow the program to link their checking and savings or money market accounts. Consumers are then rated on factors including the account's balances that they maintain, how long the accounts have been open, and avoiding overdraft fees. So again, all things we want that we've said before make sense to take into account.
It does.
Lance just doesn't like the linking part.
Yeah. No, I mean, I guess if you're worried about your credit score, these are ways that you can improve it.
Right.
I wouldn't be so worried about it.
Well, like in Lance's case, I mean, I don't know for sure because obviously you don't have access to all your finances, but based on some of what you've talked about.
It sounds like it could if I just link it all.
You probably maintain a decent amount in savings, right? So
I might.
In your case,
I don't want people out there looking me up trying to find out.
You would further boost your saving. You would further boost your credit score by linking your savings because it would show that you have a high amount of cash on hand.
Yeah, but you only need to boost your credit score if you want to borrow money, and I'm against borrowing money.
I know.
Oh.
But you just did. You do all the time. You have a house, don't you? You didn't pay for that with cash.
No, but I'm trying to pay it off as quickly as I can.
I know.
I do not like owing people money.
No, I don't know. Does anybody like owing people money? Maybe.
$8,700 average. On a credit card. I've never had that.
But see, that you don't usually phrase it as I owe someone money. It's I owe this company money. If we made it more personal, maybe less people would
do it.
Right. Because, owing your friend money, I guess some people really just don't care. But to me, if you're thinking about, I owe Lance money, that makes me more uncomfortable owing another human being some money.
As Ben Franklin said, neither a borrower nor lender be.
So, but those are a couple things you can do. There's a couple new programs coming out to take more into account.
I mean, in today's society and the way money and cards and linking and computers and smartphones are all interconnected one way or the other, since these are bill paying operations, they should be counted in your credit score.
Yes.
That is logical. That makes sense to me.
Here's something I want to
So people have something good to look forward to if they're making those payments on time and if they're used to keeping a higher balance other than just the minimum in their accounts that they pay from.
Right. Here's an idea that's not included in this.
As long as you're not burying them in the backyard in
like
coffee cans like I do. Right.
Now when you see a bunch of our fans show up at your address with shovels. And start searching your yard, you'll know why they're there.
Metal detectors.
Yeah. That's probably more effective than just digging. But one thing that I've thought for a long time, and this is because I have personal experience with it, is something that should be taken into account specifically in regards to mortgages, Lance.
Okay.
When you go to refinance, I think they should take into account what your existing payment is. And what I mean by that is if I've made my payment on time, every time for say 5 years, right?
Okay.
And just say that my payment is $1,000.
All right.
Okay. And I'm going to refinance. And by most measures, my payment would drop to say $700.
Okay.
Okay. I know you can take all these lovely mathematical things into account. But if I've been able to pay $1,000 a month for 5 years on time, every time, as a lender, like if I was just going to give somebody money, that would be stronger than anything else that they could show me. And saying, well, sure, I'll let you pay me $700 instead of paying somebody else $1,000.
Mm-hmm.
Because you've paid $1,000 for 5 years. So you can absolutely now pay $700. It just seems really common sense to at least factor that in. I mean, I wouldn't expect any bank to make that the sole factor, but I think that should weigh heavily on whether or not you can be approved for whatever your new payment is. Have you ever made a payment of this size or larger on time consistently? And if the answer is yes, then that should be a big factor in, will you make this payment
because
on time?
You're refinancing or you buying something new?
Refinancing.
Oh, okay.
So it's the same asset. It still has the same value, but I want a lower payment and I'm offering you my business and I've proven that I've been paying somebody else for a certain amount of time.
So are you just refinancing because the interest rate's lower or because you're going to extend the payment time
just
from
the interest rate.
15 years to 30 years? Oh, okay. Well, why wouldn't they give it to you?
Well, they should, but that's because
you mean they don't sometimes?
Right. This is a true personal thing Brett and I are going through right now is.
Oh, because of your credit score or whatever?
They will not extend. No, they won't extend a mortgage to us, even though we already have one and we're paying by some measures, 40% more than we need to pay. And
because
it's like,
their algorithm says no.
Right. Because
even though basic common sense says.
And I've been on the phone with the people and they're like, I understand what you're saying, but
I can't make the numbers work in the algorithm that the company says I have to use.
Right.
So therefore I have to tell you no. Yeah.
It's really frustrating.
Yeah.
It's just because it's so silly.
Sure.
It doesn't make sense, So that would be the big thing that I would change about it. And I think that's just across the board. I mean,
I'm sorry, I didn't
mortgages.
follow you there for a second because what you said was like, well, that's so silly that why wouldn't anybody do that? But now I understand.
Yeah. I mean, we want to do it.
Sure.
But we don't fit.
No. What I'm saying,
why
wouldn't somebody take your business?
Exactly.
And want the money coming into them.
Well, and if you could
obviously you show that you can afford to make the payment.
If you can sit down with a banker and say, look, here's this history and they make the decision.
Right.
Then there's no algorithm.
Right.
But we don't do that anymore. Manual underwriting is almost a completely lost.
Oh, well, that's basically what I do, but you got to go small town banks to do that.
Well, maybe I can go in with you and you can say, hey, this guy, he'll make the payments and maybe they'll.
Yeah, they want to loan me more money. I just won't take it. And the interest rate's really good.
Yeah.
They do. Well, I'm a good paying customer.
You need to own my home and that way I can get a better deal.
Yeah, I'll buy your house from you.
That's right.
And I'll get a better rate and then I'll sublet it to you.
Right, yeah,
Right.
Okay.
But I'm going to charge you $800.
I'll have a mortgage with you. You'll have a mortgage with the bank. Okay. Got it. And you'll make but everybody still wins.
Sure. You go
Your
down from
bank gets to,
and you go down from 1,000 to 800 and I make $100 a month.
you know, the system's messed up when you got to do it that way. I tell you what, that something's not right.
That's why I like American capitalism.
Yes.
Just found a way I can make money.
The real kicker though is that scenario we just described, right?
Yes. Mm-hmm.
That's a huge part of what led to the financial crash is because it wasn't person to person.
Right.
But it was banks selling bad mortgages to other banks and other, financial institutions.
Mm-hmm.
And then, of course, when a default happens, the dominoes.
That's right.
The dominoes fall.
You push the one and they all fall.
Mm-hmm. So be sure to check out this article at thestateofus.org. There's a couple other myths that we didn't make it to and talk about, but I think we covered the big ones.
There's some other charts and graphs that are interesting in the article that we didn't refer to.
Correct. Yep. So take a look at all of that and always let us know your thoughts. Links to social media are on thestateofus.org. And we like to hear what you think because that's what makes all of this successful. So Lance, we've challenged our listeners, right? And if you're a new listener, you're being challenged currently to bring in other people to the conversation because that's part of what makes this valuable. If we spread the knowledge, we spread the edumacation to places,
the better we all become.
That's right. The better we all become. So if people want to invite somebody to listen, what are the ways they could tell them to tune in?
They could tell them to use the apps like Stitcher, Spotify, Apple Podcasts, and anywhere else fine podcasts are found.
Gotcha.
Or they could listen together. They could have a listening party.
Yeah. Okay.
Except that doesn't help our ratings. Everybody's got to turn their own phone on.
Well, they could
put earbuds.
Yes.
They could put in their earbuds. Everybody listens on their phone and then they text one another. Then our ratings go up.
While sitting in the same room.
While sitting in the same room.
Okay.
That sounds exactly like a millennial thing.
I was going to say they could all be playing it, but mute it and just listen to one. And that way they're all, you know what I mean? So
I
one
think they have to have their earbuds in and
Okay,
text each other while they're all sitting in the same room.
That would definitely be more on par. I was just going for the more social.
I'm looking for the most listeners possible.
Okay. So, and we got to give a shout out. We have
who we shouting out?
Bradley is back in the producer's booth today.
Cool to have Brad back.
Yeah, Brad back. So, but I think Caleb's still editing this one.
Yeah, Bradley got game though.
Okay.
He comes right in.
Caleb's not dead. He's okay.
No.
He's still alive. He just wasn't available at this time. So we got Bradley
It's nice
back.
to have Bradley back.
For the State of Us on TrueChat in Urbana, I'm Justin T. Weller.
And I'm Lance Jackson.
Thank you so much for tuning in. We'll see you next time. Be the change.